Okay, it is 11:01, or 11:02, I should say, so we will kick off. Good morning, everyone. My name is Mark Voinovich. I am the Chief Operating Officer here at Amfin, and I'll be your host for the webinar today. I wish to extend a warm welcome to everyone in attendance. We really appreciate you taking the time out of your day to join us, so thank you. We're delighted to have with us today Mr. Peter Munckton, Chief Economist and Head of Market Strategy at the Bank of Queensland. For those of you who may not have had the opportunity to hear Peter speak before, I can guarantee you this will be an enjoyable and informative session. No pressure, Peter. Today, Peter will be providing practical insights about our current state of the economy and key factors impacting business decisions in the current climate. Today, Peter will cover the outlook for the remainder of 2021, the impact of the economy and COVID-19, and the impact of the economic environment and what that is having in regards to business decisions. The presentation will be followed by a Q&A session where attendees will have the opportunity to ask questions. Now, before I hand over to Peter, a few important points to note. Firstly, the session is CPD accredited with the MFAA and FBAA. To earn your CPD points, you will need to stay on for the duration of the webinar, which will enable you to receive your CPD codes in the follow-up email. In relation to the questions, please feel free to submit these through the chat function. You will find this by navigating to the top right-hand corner of your screen, and it will be indicative of a speech bubble, which is generally located, as I said, in the top right. Questions can be submitted during the webinar. However, we will look to address these questions in the Q&A time at the end of the presentation. And without further ado, I will hand over to Peter to present his State of the Nation update. Peter.
Yes, thanks very much, Mark. And to go through all those things in 25 minutes or so will be a real challenge. Now, just so you know, you might end up hearing a little bit of sound in the background. Where I am, there are 3 houses to be built sometime in the next year, and what they're currently doing is knocking down a whole lot of trees, so that might be the sound you end up hearing. Now, I'm going to sort of share a presentation. Hopefully, it all works. It worked beautifully, as it always does in practice. If it doesn't, then someone please let me know, like Christina. All right, so as always, we start off with a slide, so thanks very much for coming. Always in these presentations, there's one really important slide, one you should not forget, one you should burn on your memory. In this particular presentation, it is this one. There it is. Do not forget, it's the most important message of the lot. It is all general advice, what you're about to see. Now, obviously, very recent events in New South Wales and increasingly so in Victoria. I don't know whether you guys have caught up with the news of Victoria, but the numbers increased to about 50-odd cases yesterday, which is they've really struggled. You know, what looked like a sort of modest outbreak has been a real struggle in terms of keeping on top of it, and it's sort of outbroken a little bit. So obviously it's had a bigger impact on the economy. If we just went back 6 to 8 weeks ago, most people thought, well, look, we've seen a few of these over the last 6 months or so. They last for a couple of weeks and we move right along. Clearly, there's been big developments since then. And I just want to quickly touch on those as a start, because obviously that's the most important thing in terms of what's the outlook, economic outlook, what does this mean for the outbreak? And it really comes down to 3 things, right? What's the degree of toughness, if I can use that term, or stringency of the regulations you've got to put in place to deal with this? The second one is the spread of the virus, and the third one is the length. All right, so on stringency, and if you look at the left-hand chart, this is data you can get from Google, looking at how much time you actually spend at home. And if you look at the blue line, New South Wales, essentially the proportion of time spent at home, or the proportion of people at home, is back to the sort of levels we saw in the nationwide lockdown last year, ditto in Victoria. All right. Now, if you look at WA, on the other hand, which is the green line in that chart, they are back virtually. Zero is sort of pre-COVID sort of times. They're virtually at pre-COVID levels, and Queensland's somewhere in between. So the first point to note is that sort of the severity is quite strong, certainly back to where we were in the second quarter last year. If you compare our severity, though, to say UK or Italy, what they went through last year, we're nowhere near as strong as them. So we are severe in terms of what's happening right now by our standards. We're not quite as severe as the most severe global ones. The second one, as I mentioned, was the spread. The chart on the right-hand side is from the Reserve Bank, right? And they did this chart at the start of August. And what this gives you an indicator is what proportion of people are on lockdown. As you can sort of see, as at the start of August, that number was about 20%, essentially Greater Sydney. Since then, we know we've got to add Victoria, which is the purple bar. And indeed, if you look at the very left-hand lot with New South Wales, that was all of New South Wales in lockdown then, which is about 35% economy. So the 35 to Victoria, which is around about 25%, then all of a sudden you get 35, 25, which is like 60% in lockdown. So we are, in short, we've got a more widespread lockdown now than we've had any time since the second quarter of last year. So it's as stringent as was the second quarter of last year, and it's as widespread as since then. The third one, as I mentioned, was all to do with the length. If you look at these outbreaks, I will call them uncontrolled outbreaks, that's happened globally, they usually last somewhere between 2 to 5 months. Clearly, this one's not going to stop, and 2 to 5 months would be you'd finish at the end of this month. That's clearly not going to happen. So that suggests this one will at a minimum go to the end of September and more likely drip into the fourth quarter of next year. What sort of things do we need to watch out for in terms of how long it will last for and how you get confidence? Well, one, as I said, is that the global experience that goes for the 2 to 5 months. The second one is the stringency of lockdowns, which I've already touched on. The third one is obviously how we're going on terms of vaccinations. This one was done, a couple of days ago, and it shows you the vaccination rates across age group. 80% is sort of the number we're looking for. Now, to give you an idea, measles needed a 95% vaccination rate before that stopped spread. And we know this is a very contagious disease. And the evidence is globally is that when you do get big numbers, like 80%, you still get a rise in new cases, right, just because of how contagious it is. So it's not even clear to me, to be honest, that 80% will be the number. Let's just say 80% is the number. How are we going on that? If you look at the age groups, those above 70 are already there. We're getting pretty close to 85%, which is good. But to be honest, so they should be, because if you look at the mortality rates, that is where it's most severe. The next one is over the 60 to 70 age group. Really, you want to sort of see 85% of that age group vaccinated. There's no excuse for not to be, because for them, the vaccines are widely available right now. And really, we're running a little bit behind that schedule. Then on the 40 to 60 age group, you probably want at least 80% done there. And that's the age groups where there's been the fastest increase over the last two to 3 weeks, and they should continue to increase. Whether we get to 80% was a slight question mark. The reason why we need that, so overall for society, we need 80. We need the older age groups that need to be bigger than that, partly because they're the groups most impacted by this, but partly because it's highly likely for those under 40, we won't get 80%. That's what the surveys suggest. Now, if you look at them right now, the numbers look pretty low. Unsurprising, but because for them, up to extremely recently, they said they could only have Pfizer, and the supply of Pfizer still was quite limited. So the short and long of this is that in terms of vaccinations, it is picking up, although it will take a while. If you look at our current pace, which probably should increase in coming weeks, it suggests that sort of by mid-end November, we should hit that 80% mark if we can get everyone who needs to get that vaccination. So that's why you can sort of have a fair degree of confidence, the international evidence, what we've done with the restrictions and the vaccination rate, you can sort of say in the fourth quarter, it will end, more likely October, November than December. What does that mean from a growth standpoint? It does mean the third quarter GDP will be quite negative, nowhere near as bad as it was in the second quarter of last year for the reasons I've gone through, but certainly quite a big one. Will that mean a rise in the unemployment rate? The answer is probably a little bit, but it was only a few weeks ago we were very worried about not having enough workers, and it's very unlikely in a few weeks we're going to go from businesses trying to find people to laying them off very, very quickly. So there'll be some rise, but not a big rise in the unemployment rate. Then the next question is, what does that mean? So we're going to have this patch. We're not quite sure. It's going to be the end of September, sometime at the end of November. That's probably when it will finish. Sort of a little bit of doubt about how big it will, how slow growth will be, but we know it'll be pretty slow. But once we come out of that, we know that the historical experience, both domestically and globally, is that the bounce back has been really sharp. Now, what's some of the issues we need to think about? So one is this one on the right-hand chart. So in the UK, they have opened back up. virtually got rid of all restrictions. This is the orange line here. It's really picked back up in terms of the number of new cases, right? So they didn't, they got quite a few people that vaccinated, but not everyone. The number of new cases picked up. The important thing is those other two lines, hospitalisations and deaths, stayed very low. Stayed very low, but have still risen, right? And so one of the big questions for us as a society is, are we going to be happy to have some rise in deaths when we open back up? Because that's going to be the really, really big question, right? What will we actually do? With the vaccination rate, we've been told, and rightly, this is our way out of there. But vaccination rates doesn't mean zero cases around. It does not mean zero cases of hospitalisation or deaths for that matter. It does mean some rise of those things. As a society, what we've been through, how will we deal with that? This is the experience of us compared to, say, the US, right? And there's a few things here that stand out. One is this is our third big wave, the Northern Beaches one, as you can sort of see there, which is between November and March. Really is quite small in comparison. This is our third really big one. This is a very different experience from everyone globally, right? So everyone globally, they ended up having these different waves. The waves didn't stop back down at zero. And quite often it was the case that one wave finished and rather like at the beach, the next wave started up straight away. And this comes down to the point that once you open back up, cases can spread pretty quickly if you haven't really got rid of the virus. So what does all this practically mean? It means a couple of things. First of all, the virus will still be around. Second of all, after what we've gone through, it does mean that governments will, even though we're going to have vaccinations rates of above 80% before the year end, it does mean that governments will put in some restrictions. Those restrictions are unlikely to be as tough as what we're seeing in New South Wales and Victoria now, but they still will be around. What that means is, with those restrictions still around, is that you will get these patches where, for example, particularly for places like restaurants and cafes, where activity will be a bit softer for a period of time. If governments don't do it, then consumers and businesses will. We've just seen, for example, in the US, their retail sales numbers have been quite weak, a big drop in consumer confidence, and that's correlated with this chart here showing a big rise in new cases. So even if governments don't say anything, consumers and businesses will do something about it. Talking about consumers and businesses, I'll go now to the next point. All right, so basically, the big profile growth is really weak right now. Most likely, a big sharp pickup in growth. There will be revolving lockdowns as we go through last year, so there'll be a bit of up and down, but nowhere near as big. The biggest issue, though, and the biggest constraint will remain a lack of people, which is something I'll touch on in a second. In terms of businesses, on the left-hand chart, there's two lines. One is how they're feeling about things, which is the green one. You see those numbers on the left, which is all about standard deviations, if you remember your maths from school. 2 standard deviations is really big, right? It's a really big change. And as you can see right now, in terms of confidence, we're not far away from that. So the first point is businesses have confidence has taken a real snap, unsurprisingly, with events we've seen over recent weeks. The second one is the orange one, though. That's how are you actually feeling about how business conditions actually are. And 0 is normal. And we're a little bit above that. So basically, in terms of how most businesses overall are feeling about things, their actual trading is still a little bit above average, but their confidence is a bit down. If you look at the right-hand chart, this is their views on various bits, right? So you see the confidence and condition stuff there. The three ones I'll sort of quickly look on here. One is forward orders. That tells you about what business will be in the future. And unsurprisingly, with about 60% of the economy, I'd say almost closed, then orders are slowing. So that sort of tells you where things will be going over the next couple of months. The second one is we've had a very strong increase in demand. We haven't been able to meet that supply. What we're seeing is a big rise in prices, both in input costs and what businesses have had to charge. And that's sort of an issue I'll keep coming back through the rest of the presentation. And the third one is, importantly, right now, businesses' confidence in the very short term, this month, next few months is down. But if you think about what their medium-term view is, they're still reasonably confident. The reason I say that is if you look at their view on employment and capital spending, if you think your business is still going to be in reasonable shape in the medium term, you still want to be employing people and you still want to be investing. And right now, this chart shows you that sort of investing activity is about normal and employment activity is well and truly above normal. And that gives you some degree that as soon as we get through this, many businesses will feel still pretty good and are still sort of looking forward to better times in the medium term. How is the conditions different between states? This is from some surveys done by NAB. It shows you, unsurprisingly, that, right, again, there's a big difference between confidence and conditions. Conditions are seen to be weakest, particularly in New South Wales and South Australia, strongest in WA and Tasmania and Queensland, Victoria in between. So a real big difference between states. Importantly, there's also a difference between industries. And if you look at that right-hand chart, again, the difference between confidence and conditions, what really stands out is that for many industries, things are quite reasonable. Construction, and most strong in mining and agri. Right? So they're the two doing very well. Many other industries are doing pretty well, but there's some really struggling. In this chart, it shows you transport and recreation, and the third one is accommodation and food services. So there's some industries been hit really hard. As the left-hand chart shows you, there's some states in particular been hit really hard, but there's other areas like mining and WA that their biggest issue is not demand at all, but it's issues to do with supply. So there's very big differences between states. Also, some differences between size of businesses. If you look at, and the latest number you can sort of see in this chart was the end of the second quarter. Big businesses were doing better than the smaller ones, and going into this lockdown, that remains the case. Smaller businesses have had less cash flow, buffer to deal with the sort of lockdowns, and that is the reason why they desperately need the income support to come from the government, which has sort of been a bit hit and miss across most of the states. Just finally, in terms of businesses, in terms of their capex anyway, what sort of the issues in terms of constraining them? Because we've seen that there has been some sort of slowing in capex budgets for understandable reasons. And that right-hand chart goes you through what are the factors. Now, obviously, one is in the near term, they're seeing less order book, so demand slowing, so they leave less capex in the short term. But those other ones, economic and COVID uncertainty. You know, if we can get through this and basically government sort of show we're more likely to keep the economy open, I think we're likely to sort of get a return to the very strong sort of capex spending we're seeing just a few months ago. So I remain very confident about the medium term in terms of capex spending at businesses. In fact, the economy more generally, but we just need to get the confidence in terms of getting on top of the health crisis and also how governments will react to that. Now, I spoke about the constraints and on businesses, right? So one of them is just a lack of materials. A second one is a lack of people, and the biggest lack of people comes from the closure of the international borders. 2/3 of our population growth in recent times has been immigration, and immigration has obviously helped in terms of demand, but it's also been a big one for supply. And if you look through this chart, this tells you the left-hand chart tells you the flow of people about, you know, the sort of immigrants came here about short-term, long-term, etc., like that. Interestingly, most people think immigration, the long-term ones, but most of our immigration is short-term, students coming here for 3 or 4 years. If you look on the right-hand chart, though, they've been very important workers in our economy, and particularly important in some industries, and particularly important in that accommodation, food services sort of sector. And so that is one of the sectors that's been hit from demand for the reasons I've already touched on, but it's also got a supply issue. They just can't get people, and one of the biggest problems there has been in the immigration front. The left-hand chart just sort of puts in a picture what I just said. That basically, if we went back sort of 2 months ago, the biggest issue that businesses faced wasn't demand at all, was supply on the supply side, and that is particularly on the labour, on the workforce thing, which is mostly to do with international border closures, but even state border closures. There's a group of people just uncomfortable about travelling between states just because they're uncertain about what's going to happen to state borders, and that's made it harder to get people. Ditto, the sort of problems about reopening the economy has created problems on getting the sourcing materials. What this means is, as we go next year, I spoke about sort of the economy reopening. Demand was super strong. In fact, if you went back 2 months ago, demand in the economy was the strongest in 25 years. I believe very, very strongly by the end of this year, certainly the start of next year, that's where we'll return to. But we're going to have this, you know, sort of rolling sort of restrictions, albeit nowhere near as much as we had. So that'll slow demand a little bit, and more particularly, it'll have a big issue on the supply side. You know, Federal Treasury sort of says that we're not going to reopen our borders, start reopening until middle of next year, and they won't be fully reopened for 2 years after that. So that means that essentially we're going to have some demand uncertainty issues for the next couple of years, but the biggest issue we'll have is getting the materials and more particularly workers will want over the next couple of years. So supply will be a bigger issue for our economy than demand. And what that means is the right-hand chart shows you is if demand for labour picks up, price for labour picks up, i.e. wages growth pick up. And if that happens, inflation starts to rise. Right, just quickly, I thought I might sort of just touch on what this means for the consumer or the households. Given this current standard, unsurprisingly, the left-hand chart shows you that workers or people, households have become a little bit more unemployment. If you look at the difference from that little dot to the bar, the biggest change over the last 3 months has been in New South Wales, unsurprisingly. Also Queensland and South Australia, because both those states haven't had many COVID scares, but have had a couple in the last few months. Whereas in WA, we're virtually back where it was. Unemployment rate is really low over there, and their biggest issue by a long way is trying to get good people. If you look at the right-hand chart, understandably, again, this is all standard deviations. The negative one shows you that currently people will have lost a little bit of confidence, again, for the right reasons. Interestingly, if you look at those bars on finance, what's your own budget like? That's about average, which shows you that all the government income support programs really are supporting people, despite the fact that the economy is largely shut in New South Wales and Victoria. Then if you actually ask them, all right, that's today, how are you feeling about the future? 5 years' time. And as you can see from that chart, it's all very positive. So in short, we're worried about today, but we've got good confidence about the future. What does that practically mean? Well, right now they're not spending, and that's the biggest negative there, is that households are sort of sitting on are saving a whole lot of money. But what it means is once we come out of this, they will start spending again, and that is absolutely what we've seen in the data in Australia and overseas. And this is what absolutely this chart shows us, that once we come out of this, households will be happy to start spending again. As I said, right now they're saving that money. Just finally, on house prices, I think that's always sort of a big thing about where people might be spending their money. I'll just quickly start on a couple of features. So there's a lot of people sort of say basically houses in this particular cycle have outperformed units. That's absolutely the case in virtually all places bar Tasmania. In Hobart, units have outperformed houses. The second one, this is on the left-hand chart, which shows you there's a lot of discussion about the regional areas outperforming the capital cities because work from home, etc., like that. If you look at that chart, that's absolutely been the case in New South Wales, Victoria and Queensland, but it's not the case in other places, particularly in Northern Territory and WA, and far less the case in South Australia. So it's really been a big eastern state thing where basically it's been the regions that outperformed. In other states, that's been far less the case. There's also been discussion that particularly that basically it's the most expensive houses that have outperformed in the cycle. And then again, that's absolutely been the case in Sydney and Canberra, but in Melbourne and Brisbane, it's been more the case that the lower price ones have underperformed. And in places like Perth, Hobart and Darwin, it's actually in fact the case that the lower price ones have outperformed. So what this sort of says is that these sort of general things about what's happening in this cycle, apart from the house and units one, it really does show you it differs between different states. Different states are facing different areas of demand and different areas of supply. As I touched on already, if you looked at what's happening in economies, WA is absolutely booming. Some places like New South Wales, Victoria right now have got bigger issues. So there's real differences between states. Overall, what's sort of the outlook on house prices? We know this year that the numbers are virtually baked in the cake. That'll be a very strong increase. The main reason for that is interest rates. Interest rates have fallen to a really low level. They stayed down there for a very long period of time, and that's the thing that's driven up house prices. This is the left-hand chart is slightly complicated, but what it shows you, if you look at the left-hand side, there was a big fall in interest rates down to -20 there. And if you look at that, there's a correlation, a very strong one, with house prices, which is on the right-hand side. So it sort of shows you the decline that we had in interest rates up to the middle of this year would have typically seen about a house price rise of about 15%. We'll probably do a little bit better than that. Important point though, unless interest rates continue to decline, what history would show you is that house price growth starts to ease off. So in other words, unless you start to make things increasingly more affordable by reducing rates, that sort of impact on the housing market actually softens over time. So the first one is, unless we forget further interest rate cuts, then the power of low interest rates is starting to get ease in terms of pushing house prices up in coming quarters. The second big thing, obviously, that drives house prices is population growth. Now, I touched on population growth. A big driver is immigration. Because of our lack of immigration, our population growth this year, as you can see, is very weak on the right-hand chart. In actual fact, it'll be the weakest in over 100 years. So what you've got is sort of, right now, there's very strong demand to buy houses in suburbs and the regions, particularly the East Coast. But over time, if we don't get that population growth, where does the extra demand for housing come from? The next one is all about affordability. right? So one of the reasons why I've had a big pickup in demand was at the start of COVID, the very low rates and house price declines we saw, particularly in New South Wales and Victoria in 2019, made homes extremely affordable. In WA, where house prices were falling up to 2019 and the very low rates, they've been the most affordable in about 30 years, at least 30 years. So you had very strong demand for first home buyers. You had strong demand for people wanting to change where they were living. That's the strong demand bit. But what do we know? Affordability is no longer improving because rates are no longer falling and house prices are rising, and we haven't got that population growth. So all of a sudden that demand factor, which has been really strong, is slowly slowing. And then if you look at the right-hand chart, we're building a mountain of houses. Now that's a good thing for our economic growth, but at some point in time, we've got slowing demand and rising supply, and you're not helped by interest rates. What must that mean? It must mean that house price growth gradually slows. And so that is my view going forward, that basically right now, we've got very strong house price growth this year, but as we go into next year, house price growth will slow. So I reckon it'll be something like 17% this year, about 8% next year, and about 4% year after, because those demand and supply things change, and we won't get the interest rate support that I touched on. Clearly different by states. It's stronger in WA. They haven't had a stronger construction cycle, whereas in New South Wales and particularly Victoria, they've had to build a lot more residences in recent times. They've been hit hardest by the slowing immigration growth, and they're likely to underperform WA in terms of house prices. So, Mark, there it is. Sort of by and large, the short term's a bit negative because of COVID. We're a little bit uncertain how long it will be, but by Christmas, I think we'll be out of this. I think next year will be a very strong one for the economy, albeit we'll go through the odd little bouts where we like we have right now, but nowhere near as bad. The biggest issue we'll face over the next couple of years is supply. Where are we going to get particularly all those workers from? And that demand and supply thing will mean that house price growth will slow over the next couple of years unless we get interest rate support. I'll take up a fair bit of time. I might open up, leave it there and open up to see if there's any questions.
Perfect. And thank you, Peter. That was, it's always fantastic listening to you. You covered a hell of a lot of content there, and definitely have a drink. You need one. Guys, so obviously we'll open up the floor for any questions at the moment. As I said, you can use the chat function to post any questions, and we will cover those. Peter, just the first question that I have actually is low interest rates. So obviously we're at record low rates, and we've never seen these before. What do you think the implications are longer term of these low interest rates on the market?
So probably it's a really good question, Mark. We haven't sort of consistently seen it this low for whatever, like even during the world wars, governments wanted very low rates. They didn't have them quite this low. What's been one of the biggest concerns that people have is that leads to a rise in debt, right? So that's the major concern. If you reduce the price of debt, people take a lot of it on. If you look at what globally has happened, if anything, the worry is people haven't taken on enough debt, right? And particularly businesses here. The particular worry is that because there's been sort of concern about how our economy is going, not only through COVID, but more generally over the last few years, businesses haven't borrowed enough to invest enough. And that's probably been the biggest issue that we've had as an economy. And we've had a biggest issue that we've had globally. So that's sort of, conversely, has been a bit of an issue. Where the worry about debt and rates really is, for us as a country, is in two areas. One is on households. So our national debt actually is not a concern. Our national debt is towards the lower end of the world. So we haven't got too much debt as a nation, but some of our sectors do. So one is household, and we quite often think and talk about that. It's certainly the case that quite a few households have taken it on. Credit growth over the last year is not really big. It's only about 5 or 6%, so that's not a big issue. The question, though, is it could still well go up. And the big worry is, can you increase interest rates significantly if rates rise? Can you increase interest rates significantly with that much debt? And the short answer is you only can if the economy is strong enough that it's given it stronger income growth, which I suppose is the key point. That what the Reserve Bank really wants to do is run the economy very strong for a long period of time, get the unemployment rate really low, drive up wages growth enough, and then enables them to increase rates because the higher wages enables more people to pay back their mortgage. So that's sort of how you we need that strong economy for a long time. And that's, and I'll finalise the answer on this. When do you look out for higher interest rates? The key one is wages growth. Because if you don't get that higher wages growth, and wages growth needs to be above 3, we found out yesterday actually it's below 2. If you don't get that, you can't pay back the debt. If you can't pay back the debt, you can't put up the rates. So wages growth is the key indicator to watch out for in terms of when there will be higher rates.
Excellent. Great. Thanks, Peter. We have a couple of questions from the floor. So one from Philip. Do you think that we'll require stimulus support packages like SMEG 1 and SMEG 2 as we've had last time for an extended lockdown?
So for two reasons, basically, that what we do know from this is that any support, or most of the support for the economy, will have to come from governments. And we know that, first of all, that if interest rates are essentially zero, as Mark points out, the lowest we've ever had, like going to 0.000, would that seriously have a massive impact on the economy? Even the sort of interest rates cuts we've already seen is influenced asset prices, house price, etc. But in terms of actual economic impact, it's been pretty modest. Where the big economic impact we've had and why our economy managed to bounce back very strongly, and as other economies are, is all about the government support. So the longer and deeper the shutdown will be, the more government support we will need. Now, the good news is that all the governments have shown over the last 18 months is that if there is a problem with the economy caused by COVID, they will do something about it. And the very relatively low debt of the state and federal governments means that they can do something about it. So there's no doubt at all, the longer and the deeper these lockdowns happen, the more governments will have to provide fiscal support. That's right.
Great. Thanks, Peter. Another question from the floor. Obviously, government has raised a great deal of debt at low cost of borrowing. We see the cost of borrowing rising over the next 24 months. Do we see that placing pressure on our ratings on the external economy?
So if I look at what rating agencies are saying in terms of how the economy is going, what they mean for interest rates and so forth like that, their basic view is that next year and the year after will be very strong ones for the economy, and there could well be interest rate hikes towards the second half of 2023. Right? And I don't disagree with either of those two views. Given that's their view, and given that's their view that the budget deficit will be big this year and a little bit smaller the year after that, basically in line with what the government's saying, they believe that the current credit rating of AAA should stay where it is. Then the next question is, okay, let's use a scenario that a shutdown is longer and harder than what we thought for this year, and then something happens next year. And the most obvious something happening next year is that there's another virus mutation, the vaccine doesn't work quite as well. So what we've seen over the last 2 years sort of has to be replicated for another year or two, right? In that situation, as the previous questioner asked, the government will need to do more, and they will do more. Then what would the rating agency outcome of that be? There's actually, in my view, quite a good chance that our rating would be cut. Does going from AAA to AA plus really matter, right? And if you look at what's happening in Japan, if you look at what happens in a number of countries in Europe, if you looked at even the US, they've all gone from AAA to AA, and they're borrowing at the lower rates than they've ever had before. Now, one of the reasons for that is that one of the big buyers of debt in this situation will be the Reserve Bank. So someone will be out there buying it, and the Reserve Bank's one of them. So that's one of those reasons that funding costs will be really low. But also more generally, in a world where most governments are actually AA rated, we've gone from uber high to where everyone is, right? So there's really no big difference. So I'm actually not that worried from a movement from AAA to AA. We'll still be able to access financial markets. If the worst comes to worse, Reserve Bank can actually always buy more. That's what they've done for the last 2 years, and there's been no big issues from that. So it's not a really big short-term implication. The more general one is, okay, here we are, and let's just say the worst comes to worst, we go down to AA. What that means is the debates we're having about sort of getting our budget better shape, we need to make sure that actually happen. So not so much now, we need to get out of this, but once we're out of it, we need to make sure that, because if all of a sudden we stay in sort of only an okay shape, and then we have to do more again, that means the rating goes down again. So it's not the first one I'm so worried about, it's the third and the fourth ones. And so what that means is that if we have to go down, it makes it even more important that we basically get our budget back to surplus sometime after that.
Excellent. Thanks, Peter. Great answer. We've got one more question, and then I think we'll call it a day. Obviously, with the low interest rates, traditionally we've used monetary policy to control inflation, and we've seen an increase in inflation, which is above the central bank's targets. How long do you think the central bank will allow higher levels of inflation? And do you see that inflationary pressure as a concern for future growth?
Yeah, it's a really important question and a very topical question. So in our situation in Australia, if you look at our headline inflation number, it's somewhere close to 4% right now. And there's a bunch of reasons for that. One of them is that sort of 1 year ago, the numbers were unusually low. So return to normal now. So take it a low number, put a high number in, lo and behold, you get a high number. So partly it's sort of mathematical reasons. Partly it's the fact that government subsidies from last year, like subsidies for electricity bills, all of a sudden were taken off. So some of that was just returning to normal, if I can use that term. So if you look at our sort of underlying numbers and sort of take away those things here and take away that there and sort of say, okay, ongoing inflation, what is it? It's about a bit under 2% in Australia. So it's picking up, unarguably, and there's a lot more inflation in the pipeline to come. Right? Now, where the big question is, and in places like the US, this is an even bigger one, because not only is their headline number close to 4, but when you take out those little bits here and there, the number's not under 2 like over here, it's actually a little more closer to 3. Right? And where the really big question is, which is the nub of what the question is this short term or how much is this long term? And all central banks and financial markets are saying this is short term, because once the economy opens back up and once people get back moving around like they used to, then basically, you know, everyone get the workers they need and everyone get the goods they need. Supply picks up, demand stays where it is. Lo and behold, inflation goes back to sort of 2% or lower. Right? That's a big question. Will the supply go back to where it was? Now, maybe on the material side it will, in terms of getting goods out and all that sort of stuff. As everyone knows, there's a shortage of cars around right now. At some point in time, overseas factories will start to chill out again, although I think it'll take longer than what people are currently saying, but at some point in time will be the case. The big question, though, is, and this comes back to the reason about why I spoke about borders and so forth like that, when will we start opening up our borders to workers and get comfortable at doing so? Not only here, but globally. And it just seems to me that the current sort of assumptions that it will happen relatively quickly next year just seem to be a bit of a stretch. I think given everything we've seen in the last 2 years, how's the society we've reacted, everything says to me that supply of workers won't be as strong as what we had pre-COVID. And that's the reason why I think, if anything, the supply response won't be as big as it was, which means prices will be higher than what the Reserve Bank think it will be, which is the reason why I think the Reserve Bank currently saying rates won't rise to 2024 looks too late, given that supply. But that is the key question. Demand, everyone seems to be pretty confident. Once we open back up, it'll be strong again. The big question is that supply one. Will we get back to where we were? And the answer to that we'll find out by mid-next year. If we don't start to see more people coming in, we know that supply of workers won't be there and wages will start to rise, etc. Good question.
Excellent. Look, we'll probably call our questions there. We have ran over time, so thank you again, Peter. Thanks for everyone for your attendance today. I'm sure you found that as interesting and informative as I have, and I always enjoy listening to Peter's talks. As I advised, for all the attendees, you'll receive a follow-up email with your CPD codes included. Finally, on behalf of the team here at AmFin and the attendees, I want to take the opportunity to thank you, Peter, for your time today and giving us those practical insights on the market, the economy and considerations for the year ahead. It really has been a pleasure. Thank you everyone for joining today. Stay safe, stay well, and goodbye. Thank you.